Welcome to our introductory class in finance. So finance has the following structure that you need to acquaint yourselves with. We'll define what finance is, types of organizations, and the users. So what is financial accounting and who are the users of financial accounting information, Irene?
Well, the users of financial information, basically the stakeholders. We're looking at investors, we're looking at customers, we are looking at regulators. Yeah, I think basically in that angle. Then financial information is basically presenting information with regards to the performance of the company so that it can be interpreted by the stakeholders that I just identified.
Thank you so much. I'm glad you were in our class. So basically, we are defined as financial accounting basically as to account. To account basically is to have a report or a record of. So there's also a biblical reference of making an account of. God requires us to take account of our lives. So accounting is not only a principle we live by, but it's also a biblical principle. So it's defined using the SEMA technology by the following. And these ingredients of the definition are actually what define or make up the syllabus. So it is the classification and recording of what? Monetary transactions of an entity in accordance with what? Established concepts, principles, accounting standards, and also legal requirements and their presentation by means of an income statement, which we'll look at, a balance sheet, and cash flow statements during and at the end of the period. So this definition of accounting basically is broken down as follows. So we'll classify elements of accounting, classifications of what assets are, liabilities are for a layman. We also learn how to record and post transactions, and these transactions are supposed to be only in monetary form with or in accordance with the established concepts that are there. So we are what we call the conceptual framework that will give us a guideline of the principles by which these must abide. So the accounting standards, the legal requirements, and also there's a format of the presentation that we need to learn. And these books that are key, which we call the final accounts, come through what we call an income statement, a balance sheet, and a cash flow statement. And each of these ones are presented either during or at the end of the period. So the purpose of accounting is in 5 strands. Number one, accounting basically gives us exactly what the company owns. So these are called assets. It also shows us who the company owes. These are called creditors. Accounting also shows us what the company owns, assets. And who owes the company? These are debtors. Company also will give us a performance over time and how the company is financed. This is what we call the capital structure. It can come from debt, it can come from retained earnings, it can also come from our own equity, which is capital that is put in. So accounting information is required to fulfill the legal requirements, also to assist managers to plan, control, and make decisions. And so we want to understand that financial accounting is not only important to business entities, but to you and me, who are not even part of the business, we are called users. So the users of financial accounting information can be grouped into 2, internal and external users of financial accounting information. So before I go to the users, we must understand that business entities can be categorized into 4 main. Number 1, we have trusts and other lands, cooperatives, business names, partnerships, and also companies. So who is a sole trader? What is a partnership? What is a company and cooperative? So in your own definition, quickly, can you give me the definitions of these important people, their advantages and disadvantages. Irene, you can start.
Okay, a sole trader is a solely owned business. This is a business that is started by an individual. And the challenges with such a business is that usually expansion becomes a challenge because they may have limited resources to expand the business and also to finance the business itself. Usually, mainly because of these challenges that this individual faces, they may decide to bring in some other people in the business. Then we are going to graduate it from sole proprietor to partnership. So a partnership is owned by two or more people, okay? And for this particular one, the advantage is that, like they always say, two is better than one. So you find that now, in terms of those challenges the individual was facing, now they may have enough capital to be able to expand, but the challenges may be, maybe the lines, the drawn lines may not be clear on how one is going to, how much ownership one has in the business. Because even in the at registrar of companies, you find there are no shares allocated to each one of them. So that may bring in confusion. Then we have the third one, which is an incorporated business. For this particular one, there's a subscription of shares, and this is indicated at PACRA, which is patent and, let me just say PACRA. So the beauty with this one is there are drawn lines in terms of ownership of the business and management. It's a more organized establishment in that it has a structured management in place. I think that's what I can say in brief.
In my entirety of teaching this course, that is one of the best elaborated explanations that I've ever received. Thank you so much and keep it up. That is exactly.
Thank you.
Yeah, so we've just summed it up for us. So just to give the summarized notes as well. So a sole trader, a business owned by a single person. So the features are shown below. So she's mentioned so the characteristics are shown, the single ownership. In terms of decision making, they're prompt and quick. You have unlimited liability, meaning the owner is personally liable for the business debt. And simplicity, it's very easy and inexpensive to operate. The advantage is that there's direct control, the owner has full control over the business, and there's flexibility in decision making. So you can adapt to changes in the market. There's no rigidity. The tax burdens here, you only pay one kind of tax, which is called the income tax. Then it's easy to set up. The disadvantages, you have limited resources. Now, these resources are limited or tied to an individual's pockets and a few friends. And limited expertise because you're the only person who could be an accountant, but you may not have engineering skills. So they are limited to an individual's expertise. So there's also unlimited liability, meaning the person's assets are at risk when there's a debt. There's limited growth and potential because you are an individual and limited what you put in. So partnership is a business owned by two or more persons who share profits, and the features are that there's shared ownership, joint decision-making, there's unlimited liability, and there's a partnership agreement that can be either verbal or written. So the advantages are the diverse of skills, so meaning people bring in on the table their skills, their monies, there's easy information sharing, and also tax burdens are shared. So in terms of disadvantages, there could be disagreements between the partners that may affect the overall running of the business. There's unlimited liability, meaning personal assets are at risk because personal decisions that made in this partnership are binding on the entire partnership. So we also have what we call a limited capital. So this limited capital is still limited to the contributions of the partners. So partnerships, except for professions like accountants and legal firms, they're limited to 20. Corporations, this is a legal entity separate from its owners, limited to the shareholders. So we have limited liability for the shareholders. Okay, we have corporations and we have companies. So corporations are entities where individuals who sell goods to their owners at a reduced price compared to the market price, ensuring that the individuals that are part of this entity benefit. All right. So best example is that the marketeers. So for companies, we have public and private limited companies in Zambia under Cap 388. One becomes incorporated, and when they're incorporated, they now start functioning as a company. So the features of the private company is that there's restricted ownership. This simply means that shares are not publicly traded, there are fewer shareholders, limited to a family, and there's less stringent regulations compared to public companies, and there's more privacy. So the disadvantage is that the advantage is that there's more control here on who enters a company because the private limited company, there's flexibility and less scrutiny when it comes to the law. Long-term focus, meaning here you can focus on long-term goals without pressure on the markets. You can't always be put under pressure to publicize your accounts, to also follow market trends. You have your own trajectory to grow. There's privacy in a private company. The disadvantages are limited capital, meaning you're restricted to the company capital compared to the public where anyone can buy in. There's also less liquidity because shares are not tradable on the stock exchange. And there's also limited expertise because of the lack of diverse of skills. And also exit challenges is limited to the options of selling shares. Public companies, on the other hand, trade their shares publicly on the stock exchange in Zambia, Lusaka Stock Exchange. And we have a number of shareholders, two types of shareholders, what we call the preferential shareholders, who are speculative investors who are paid first, and the ordinary shareholders who are the real owners of the business who are paid last but have voting rights. There are stringent regulations in a public company, and also we have higher disclosure requirements, transparency. So here are the advantages and disadvantages. So you can see the advantages and disadvantages of a private company.
Yes, we can.
Okay, so expand on them, Irene. Advantages. Okay, so the advantages are that there's access.
How much can you really get doing both?
Did you get me? So advantages are that there's access to capital, which is easier to raise funds through public offerings. Liquidity, it means when a company is liquid, it means shares can be traded, bought back and sold on the stock exchange. There's also enhanced visibility, meaning there's a higher public profile. So meaning the account of a company which is trading on a public stock exchange has to publish the accounts publicly. So people have to know what is happening in there. The profile that a company may have may be an advantage and disadvantage at the same time. If you're doing fine, it's an advantage, it's a big company. So employee benefits are easier to offer. So employee benefits were easier to offer stock-based employee benefits in public companies. So disadvantages, you lose control because shareholders are too many and they have their own opinions on decision making. There's too much compliance that is required. The market pressure as well, short and long term due to the expectations. And there's also public scrutiny, which may expose the company to criticism and scrutiny. So these are the companies that you need to know in our first part. So these are important to understand at least as basic information. Any questions at this point so far?
I think we're clear there.
All right. So instead of me going through this, I can proceed to the second unit. We're going to look at the users of financial accounting information. So we have custodians of financial accounting information that will need to really have access to information to which it may be interest to them or other parties. So we have internal and external users of accounting information. So the internal users are people who are working within the system. To start with, we have managers, directors, internal auditors, and employees. On the external, we have the lenders, we have shareholders, government, local authorities, analysts, journalists, and we have suppliers, external auditors, customers, general public, trade unions, and potential investors. Now, for each of these ones, I want you to actualize them. Kindly tell me what use is financial accounting information to them. All right. So Irene, you can start with the internal users. Why are these ones particularly interested in accounting information? Why should they have some basic information, financial accounting? Then we also go to external users. Someone will pick on any of them and tell us why and how they are interested parties in financial accounting information, or what benefit is it, in that order.
Okay, so for internal users, I'll start with directors. Basically, it gives them, it aids them in decision making. Because if for the first quarter, they realize that the company made a loss, it means now as ExCo of the company, they need to come in and find ways of either minimizing the loss or just trying to make the company profitable. Okay, then for the employees, they may also be able to read whether the company is going to be, say, it will help them with regards to the going concern of the company, because then they'll make a decision whether to stick around or to start looking for employment elsewhere. That's one. Then two, also it helps them in to try and fine tune their strategy so that it aligns to how the company is performing. Then for the external users, I would start with the suppliers. This gives them a picture of how the company is performing and whether they can still extend goods on credit to the company. Then for the financial institutions, I haven't seen it. Yeah, for the lenders, it also gives them a gauge whether they can still extend any facilities, new facilities to this company, whether they can recall the facility, whether they need to make remedial action towards the facility they have on that company. Then potential investors also, it gives them a chance to be able to ascertain whether the company is worth putting any investment into based on their balance sheet. I think that's my contribution.
Excellent. Very, very well explained. External users, Samuel, can you pick up an end?
Okay, so I wanted to pick the lenders and the other, the shareholders, but I'll just say something that I wanted to say about them anyway. So for lenders, as she said, like for example, banks are more interested in financing companies that are financially stable, possibly that are credit worthy. So only a company that's doing well can be worth lending money. And I'm going to talk about the general public. I think, for example, when a company publishes its finances in the newspaper, I think it's good for the customers to know what's really happening. Say, for example, they want to bid or something, they need to know what company they are working with. Then for external auditors, sorry.
Okay, that's great.
Yeah, so for external auditors also, they need to know if a company is compliant. They'll check if it's abiding to the financial regulations and stuff. Yeah, so lastly, I'm just going to pick on competitors maybe. Yeah, so when competitors when they have access to see how their competitors are performing, I think maybe it's easier to gauge the market to see if they're doing better or worse than them, so it can help.
Exactly.
Like, yeah.
All right, thank you so much. So as shareholders need information for future current profits. These are the owners of the business. So whilst they're in the business, their interest is the dividend. So they want to see whether there is a financial strength in this company and they're doing fine so they could claim. Same with potential investors. For the employees, they want to secure their employment and also solicit for pay raises. So they can only do that if they understand some basic accounting. Trade unions, they're the ones who solicit, who bargain on behalf of the employees. So they will need that information so they could now either allow a strike to go on or not. The customers are there to assess the ability of this company to providing them with supplies for a foreseeable future. So they need to know whether the company continues to supply them what they need. They don't want to have stock out costs where you come, there's nothing available. The suppliers also want to know whether they'll be paid because this ones usually supply on credit. So competitors also, they there to compare, to make economic decisions based on their competitors. Government agencies want to know whether the company is performing in tandem with the economy's trajectory. So they want to plan. This is where they make budgets for the entire nation as a whole. Managers for internal use like control, planning, and managing a company. The board of directors to formulate strategies. The lenders to know whether they'll be repaid. The solvency of the company. The journalist is a source of public information, and the general public, they want to know whether this company is able to support them using social corporate responsibilities. For researchers, the data is essential for their research, and tax authorities, whether they're compliant with taxes. So financial accounting has already been defined as classification and recording of monetary transactions within the established regulations. Management accounting is a process of identifying, measuring, accumulation, analysis, preparation, interpretation, communication, information used to evaluate, control an entity, and to assure appropriate use of accountability. Basically, it's for internal use. So if we're going to look at the differences between the two, I'll show you a tabulation that is given for the two. So financial accounting is mainly for external users. This one, management accounting, is mainly for internal users. So the factor, it's provided using past performance. This one uses historical data, management accounting. The legal requirement, financial accounting uses legal requirements that have been set, whereas management accounting, there's no legal requirement that you need to use. The format for financial accounting is as given by the accounting standards. Here, there's no standard that you need to use at the discretion of management. The type of information here is mainly mandatory. Here, we use both mandatory and non-mandatory for management accounting. So this is how Unit 1 ends. So quickly, we'll go through questions that have to do with Unit 1. So which one of the following is not a requirement of the Companies Act, which one is not a requirement of the Companies Act. So it is statement of the comprehensive statement. Not this one here. Okay. One. Okay, let's not change one. So we go to structure number 2, where we look at the regulatory framework, the rules, and the conceptual framework. So like I said, there are established accounting standards and principles that have been laid out that need to be adhered to. So by definition, we talked about financial accounting being dealing with financial or monetary transactions in accordance with the concepts that have been established. So these concepts that have been established make up what we call the regulatory framework. It has 3 important components. There's the national company legislation, the international financial reporting standards, which we call IFRS. There's also the stock exchange rules. So this is what makes up what we call the regulatory framework. Now, what are accounting standards? Accounting standards basically are the authority in finance that explain how to deal with certain problems relating to evaluation, closing stock, measurement of property and equipment. So this is what we call an accounting standard. So what do we need? Why do we need these accounting standards? So like we do have a socket that we can buy in the EUS and it can work in Zambia. We also have accounting standards that could be applicable wherever. So accounting standards will give us a common form and content of accounts, such that when we go wherever, we can have auditors from whatever country that will ensure that these form of standards are followed wherever. So the rules that are imbued in the accounting standards look at the entity, types of entity, which can either be a private sector or public sector. So when dealing with the private sector, what governs the private sector is what we call the international financial reporting standards. The public entities like government is guided by what we call the International Public Sector Accounting Standards, IPSAs. So these are the governing bodies that we need to know. So in the private sector and public sector, I've explained. So the list of international financial reporting standards is streamed from ISA 1 up to IS 41. Each of these ones I'm not going to the nitty-gritties of what each one of them is specifically, but these are simply regulatory standards that will guide whatsoever regulation there is. Then we also have a conceptual framework for financial accounting reporting, which has a comprehensive set of concepts for reporting, which is issued by the International Accounting Body. This one provides the concepts, it provides guidance that will underpin decisions that the board makes when developing the standards. So we have the latest one, which was done in January 2020 after the revised one of 2018. So the one we're using currently is the 2020 framework. And so the purpose of the conceptual framework is to assist the board to develop the international reporting standards. The other purpose is also to help those that prepare financial reports to develop a consistent accounting policies for transactions or other events when there's no standard that will apply. The conceptual framework also will help assist all parties to understand and interpret these standards. So this is like the Bible for accountants. Now we go into basic elements that we need to adhere to. So there are what we call qualitative characteristics and the elements that we use. So there's a formula that I'll need to make for you that will help you memorize this. But the objectives of financial statements is to provide information that is useful to who? To the users for decision making, which is relating to the resources of an entity. So we have elements in financial statements such as the assets, liabilities, equity, and revenues, expenses, gains, and losses. So what are assets? Assets basically represent an economic value which is controlled by an entity. Assets could be issues like cash, debtors, motor vehicles, what an entity owns. And liability, on the other hand, is an obligation to transfer an economic resource as a result of past events. Examples could be loans, creditors, accruals. So an obligation or duty to pay is called a liability. So if you have an obligation to pay something, you're supposed to pay rent and you didn't pay an accrued rent, that is called a liability, what we owe. We also have expenses. Expenses actually decrease assets. Okay, so an increase in liabilities means expenses have gone up. We also have income and revenue. So increases in the increase in income means is increase in what? Assets. Decrease in liability means is decrease in income. We also have equity. Equity simply is the money that is put into the business by the owners, like share capital, retained earnings. We call that equity. So when you start a business with your own money, we call that equity. We also have what we call the qualitative characteristics of financial statements. So we have what are called the fundamental qualitative characteristics and the enhancing qualitative characteristics. So RF is for the fundamental characteristics, which look at relevance and faithful representation. Okay, then here we use CAT-V. So comparability, understandability, timeliness, and verifiability. So these are the enhancing characteristics that we look at when we come to describing information. Now, what does it mean when we're discussing relevance? What does it mean when we're discussing faithful representation? Okay, so this is how you need to explain or expand these ones. So when you're dealing with the qualitative characteristics, these ones usually play a very critical role in financial reporting, especially when it comes to decision making. So we divide them into two: the fundamental qualitative characteristics, which we call, and also enhancing qualitative characteristics. So under the fundamental, we have concept of relevance. So meaning the information must be relevant, that it should influence an economic decision to the users by preparing them with present, past, and future events, informing them correctly of these events and their evaluations. So this we also have faith representation, which looks at how the information depicts a faithful report of phenomenon, which should be complete, should be neutral, should be free from error. So completeness means all necessary information should be provided. Neutrality means that it should be unbiased. Free from error means it should be accurate without any mistakes. So when we go to enhancing characteristics, CAT-V. So C stands for comparability, meaning you can easily identify and understand similarities and differences between the items. So there should be elements of consistency and comparability in there. So financial consistency means that it should be presented in the same manner over and over. Comparability means across all boards, users must be able to compare information across different entities. Timeliness means it must be provided in good time. Sometimes a newspaper becomes useless if it was provided for a next day, which was last week's information for the next day. So it must be timely. And in-depth discussions that it must have relevance over time and also balancing act. So timeliness here, we're talking about it ensuring that all information remains what? Relevant and does not lose its value. And there should be a balance between providing information promptly and ensuring that it is accurate. Understandability. In terms of understandability, information must be comprehensive to the users. So they must understand, even a layman must say they've made a profit or loss. There should be clarity, be presented in a manner that is concise and must give the knowledge level to the intended users. Verifiability means this information must be independent, must be knowledgeable, and independent observers can reach a consensus to say, okay, this was within the acceptable standards. So verifiable meaning it must be auditable. Auditors must come and say this is correct and in tandem with our requirements. It must be reliable. It must be able to replicate results through similar methods of data. So this is very important and makes up the characteristics of qualitative information. Is that clear? Is that clear? So I have explained all these in terms of their context. And so I will end by looking at the underlying assumptions that are there. So there are principles and assumptions that you need to know. So the assumptions that we have reporting entity, going concern, so meaning the company must be separate from the business. Going concern must view the business as having a foreseeable future that may grow in future. Monetary unit means that you should always value elements in monetary form. Periodicity, there must be a time factor as you produce these reports. So these are the underlying assumptions that we need to have. So we'll end here. I'll send you questions just on these 2 units, and I'll need my solutions thereafter. Unless there are any questions, you can ask at this point. Is this clear?
Yes, it is.
All right. Thank you so much. Have a great day. So next class, we'll look at Unit 3 and Unit 4. So this was an introductory class. I'll send